as much as I want to see all your cute faces, which I'm going to pull up on the computer, but you just won't see mine. I'm sorry.
Well, we miss you not being here.
All right. Are we ready?
I missed not being there, but yeah, start whenever.
Okay. We will call to order the General Employee Pension Board. It is Monday, June 13th, 2022 at 10:36 a.m. Roll call, please.
Delana Natali,
Here.
Brenda DeWeese,
Here.
and Tina Hilton.
Here.
Tim Sopko is absent. Bridget Bassier is on the phone joining us.
Here.
Yep, she's here. So we do have a quorum. Wanted to also let you know that we have your Salem Trust representative, your new Salem Trust representative, Inez Garcia. She's also on the phone as well.
Okay. Welcome, Inez.
Yes, thank you. Thank you so much.
In order for Bridget to participate in the meeting, you all will need to decide that she has exigent circumstances under which she is not present in the room. So that would just require a motion to allow Bridget to participate electronically.
I make a motion to let Bridget participate electronically.
I second.
All in favor?
Aye.
Opposed? Okay, you're part of it.
Thank you.
Okay, next on the agenda is public comments, and seeing that we have none, we will move to item 3, approval of the minutes for March 14th, 2022. Are there any corrections or comments regarding the minutes? If not, we will look for a motion to approve.
I make a motion that we approve the minutes of March 14th.
I'll second it.
All in favor?
Aye.
Aye.
Motion approved.
All right, if we could just take a brief pause here. I'm just having a little bit of trouble opening up the attachments. Sure. Seeing I have to launch Adobe Acrobat. I've never had to do that before.
If you hit the little Windows button.
Delina was saying if you hit that little Windows button down in the corner.
There you go.
There, thank you. Okay, I think that means it's launched.
Yes.
Tour, but thank you.
Oh, you just closed it. But it accepted it.
Okay, good.
That's weird.
I've never had to do that before, so okay. All right. Okay, thank you. I'm ready.
Okay. Move on to item number 4, new business. Item number A, State of Florida rate assumption recommendation, state acceptance letter. I read through this, and I guess what I read is that there looks like they're recommending a different assumption range versus what we've approved at our last meeting, which I believe is 6.25% instead of the 6.75. If I remember right. That is.
No, I think we decided that because we were at a credit, we would put it to the 675, so we wouldn't have to worry about.
It's 6.25. Yeah, you guys are at 6.25 now.
Yeah.
6.25.
Yeah.
So I think one of the things that you should be aware of is that these letters are going out for nearly everyone who's in the 3-year cycle. So the state of Florida reviews your actuarial valuations, but they only review them once every 3 years. So as they are reviewing the actuarial valuations, they are looking at the assumed rates of return. And they are sending these letters to almost everybody that they review. with a different expected investment rate of return assumptions. So their range is different. And almost regardless of what the assumed rate is for the pension fund itself. So how yours is at 6.75, which really is at 6.25. Their, their number is 4.75 to 5.75. I mean, I've had clients who are in the 5% range in a closed plan, and they've suggested a lower number than that. So, there's not really any, at least as far as I can tell, there's not really any science that they're putting behind it. They just want everybody to reduce their assumed rates of return. But I don't know, Frank, if you had any comments other than that.
In our experience, it's about shown effort. The fact that we lowered it to 625 is already a large decrease. I think we're totally fine. If they challenge us, we can always kind of create our own rebuttal. So I'm not too concerned about what the logistics are within the document itself. I think it's important for us to keep in mind that in the long run we should lower, but there's no urgency to do it as aggressively as the state has suggested.
Yeah, I was just looking at it because our actuarial just reviewed this at our last meeting, so I don't know when the state was looking at this, but I would venture to say that our actuarial that we're paying is looking at this a little bit more closely than the state is.
Yeah, so if you look at the reference, they have reviewed the reports through October 1st of 2020. So they have not reviewed your 2020 report. So they won't review that for another 3 years now.
And who knows what's going to happen between now and then.
Very true.
That's later on in the meeting, right, Frank? Okay, any other comments regarding the state's letter? All right, item 4B, proposed ordinance amendment for the joint annuitant changes.
Yeah, so you have a drafted ordinance in your packet. This came up, if you remember at the last meeting, we had a member who had requested after they were retired to change their joint annuitant. And then we had at least one other person. Michelle, refresh my recollection. Was there more than one?
We did, and I apologize. I wasn't able to upload that after I had already published the agenda, so I wasn't able to upload it. But I printed everybody hard copies.
So changing your joint annuitant.
I printed 2 hard copies. I'm sorry.
That's okay, I printed one.
Oh, okay.
Okay,
I'm
thanks,
just saying I
guys.
got it on my iPad if you needed it.
So changing your joint annuitant after retirement is not something that happens in all pension plans. But in the state of Florida, police and fire pension plans are allowed to do that. They do have a standard. Actually, it's not just that they're allowed. They are required to include it as an option within their pension plans. So, in the governmental sector, I think it's something that people are aware of. So your ordinance change is modeled after what is allowed to happen with the police and fire pension plans. So essentially, we've indicated on page 2, struck out that any annuity contract distributed shall be non-transferable, but that the optional form of benefit chosen at retirement cannot be changed after the receipt of the first benefit. We are also including after the annuity starting date, the participant can change his or her election of beneficiary or contingent annuitant only twice. That's what the state statute says for the police and fire plans. That's not, it's not something that's mandated on you. But my suggestion is that we keep it to that level for a couple of reasons that I'll talk about in a minute. That any participant who desires to change their beneficiary or contingent annuitant shall file with the Board of Trustees a notarized notice of such change, either by registered letter or on such form as provided by the plan administrator. That once the administrator receives a completed change of beneficiary or contingent annuitant form, the board shall adjust the participant's monthly benefit by the application of actuarial tables and calculations using the plan's definition of actuarial equivalence, and there's no impact to the plan. Unless the evidence of good health is provided, the beneficiary or joint annuitant being removed will be assumed deceased by the actuary in determining the actuarial equivalent amount of the revised monthly benefit. And no retiree's current benefits shall be increased as a result of the change of beneficiary. So the reason why I suggest having limitations is, that second part of the provision. It reduces the member's benefit to take into account who they're leaving it to. If they're unable to prove the good health of the person that they're removing, their benefit reverts to what would have been left had that person died, had one of the two people died, which would have been the survivor benefit. And then the reduction for the new person is taken from that standpoint. So that's why I'm suggesting only twice, because ultimately the benefit gets, I wouldn't say significantly smaller, but gets smaller as they substitute other people into the mix. Does anybody have any other questions about it?
I'll use me as an example. So if I have a joint person already assigned, and the divorce, or that happens, and I wanted to leave it to my disabled son. Now that this would give the option to do such.
That's correct.
Okay.
So nobody should get divorced more than twice.
Right.
Or so some of the strategies that people use in lieu of doing this kind of thing is that they take part of their benefit and buy life insurance that would substitute. So in other words, if your benefit would be reduced on a monthly basis, figure out what that amount would have been and buy insurance that could be, annuitized for your surviving spouse.
Any other questions? Bridget?
I have none.
I had a comment. Could we determine who would bear the cost of the calculation? Do we need to do that?
Well, I think we should wait until it passes, but you
And
could
then we'll
ask.
make that, okay.
Yeah, you could ask.
Something to
Do you
about.
think the member, I'm in most cases, the member bears the cost of requesting this, because it's not something that is universal to all of the members in the pension plan. And it's, I think $300 for a calculation.
250, 300, something along those lines. Yeah.
So it's not outrageous for the member to have to pay the cost of it, but, seems a little skewed for everybody to pay for the cost of the recalculation of that particular person's benefit.
Makes sense.
We did run this by Doug. Doug actually made the suggestion that we use the plan's definition of actuarial equivalence for purposes of determining how the benefit is valued. And he indicated that he would provide a no-cost impact letter for this particular change, because the member's benefit is being reduced to account for the substitute survivor. And by the way, usually if they change their beneficiary, so the beneficiary is for a certain, if they have a benefit that's paid for a certain period, there's no reduction, no change. They can substitute that beneficiary without, having any impact to their benefit. It's only for the joint annuitant that depends upon the member's lifetime and the joint annuitant's lifetime that it would have a change to the monthly benefit.
I have a question kind of relating to this. I'm not sure how it would affect it, but Does the plan offer a co-beneficiary or a contingent beneficiary in case one dies, it automatically reverts to the next one?
So you can do contingent beneficiaries. I don't know whether your form has a contingent beneficiary on it, but it's something we can definitely put together, a contingent beneficiary. But you can't do a contingent joint annuitant.
Right. That I get.
And
that-
I don't believe you all have any lump sum payouts.
They do have the certain periods, and I don't know how many people have taken that, but they have
Oh, I see. That's right.
5, 10.
And 15-year, you're right. You're right. So, yeah, our beneficiary forms, there's 6 lines. So there's 3 for the primary, and then you go down to the contingent, and there's 3 for the contingent.
Okay.
So, yeah.
Okay. Good question. Any others?
Right, so we would need a motion then to forward this on to the city for consideration.
I make the motion that we forward this to the city for consideration.
I'll second.
All in favor?
Aye.
Opposed?
Thank you.
Thank you. Next up is the item 4C, updated summary plan description.
Oh, that's me too.
Don't get too comfy.
So in your packet is the updated summary plan description. There weren't significant number of changes that were required. So we do have the requirement to update it every 2 years, so that's why we're back before you. We added to the table of contents the actuarial data that we do need to provide out to the members. The page 1, we just updated to the most recent ordinance that was passed, so that anybody looking at it knows that it's up to date. On page 2, changed the name. Page 6, grammatical issue. And then added the actuarial data up to date then as an attachment in the back. Something that the state requires that we add. I don't know how much value it has for the participants who are not versed in actuarial valuations, but the state does require that we provide it.
Any questions?
No, look good.
Need a motion to approve the new plan.
Make a motion to approve the new plan.
I second it.
I'll second.
All in favor?
Aye.
Opposed?
That wasn't an oppose. I kind of was delayed.
So, motion carries 4-0.
Yes.
Sorry.
Okay, next up we have old business, the ordinance amendment for member elected trustees, which was passed by city council last Monday.
Correct, the first reading.
First reading, correct.
Right, and I'm told that it's on the agenda for second reading. I'll follow up and make sure that there's nothing else I need to do. And in relation to that, we sent out letters to all the retirees to introduce ourselves. I didn't get back the response that I was hoping for. I think we got maybe 10 retirees that called in and wanted to update their contact information. So I was thinking that when it passes second reading, maybe we can send it out again, just kind of as a refresher, and let everyone know that the ordinance amendment did pass, and ask for the nominations again, and possibly we do need to send the SPD out to the membership, right, Bonnie?
Yes.
So maybe we can do that kind of in conjunction. Here's a updated copy of your summary plan, description, and kind of do that.
Okay, so Tina and my terms have expired, correct? Or-
Correct, but the election is ongoing.
So Florida law, so our Florida Constitution provides for officers to be what's called holdovers. So officers serve until they are either resign or replaced. So in this particular case, there's, that the term expiration triggers an election, but at this point, we don't have anybody to replace our trustees, and as long as you're willing to serve, we're good to go.
Okay. I did get a call from 2 of the members
Oh.
personally, so, going, do you really want to do this?
I was nominated for chair or for trustee, so
Oh, really?
I called him and explained that.
Yeah.
No.
That's cute.
It was kind of funny.
So now, I didn't. I guess I haven't been keeping up. I knew Brenda's was expiring, so mine has expired as well.
Let me check. I just closed.
I think both of ours expired at the same time.
I think you both are on the same date. Yes, I think so too. My little spreadsheet closed out. Come on, open up. Yes, April 11th of 2022. And these are 3-year terms.
So then, as far as I'm the employee, correct?
No, you two are member elected, and Delana is the employee, the union representative.
Union. Oh, okay.
Right. So she serves in perpetuity.
Yeah.
I think that's the correct word.
Mm-hmm.
Well, she would still need to be appointed. I mean, you still have the terms, right?
The notes I have say union member serves as 5th trustee, and the term is as long as he or she is a union member.
Okay, okay.
You can verify that? Yeah. I'll pull up the ordinance and verify it.
I know that's how it was when I was the union rep.
Okay.
But I know we've made changes, so I don't want to say for sure.
Okay. We'll verify that.
Okay, well, we'll wait for that for the next meeting.
Correct.
Okay. All right, item number 6, reports. First up, Salem Trust. Inez Garcia is on the phone, correct?
I am, yes. Good morning.
Welcome.
Thank you. Are we doing reports? I didn't really hear it.
Yes.
I was a little far away.
Time for reports. And you're up.
Okay, so we're skipping the reports and I'm up? Is that what you said?
Yes.
So sorry. Okay, well, I just wanted to say first, good morning, and thank you all for having me. As you're aware, Mindy left Salem Trust in March, so I have been her replacement on your account. So I'm looking forward to meeting you all. I wasn't able to make it up there for this trip, but I have spoken with Michelle, and I do want to come back for the next meeting and go over a little bit of the portal, the pension portal that we want to roll out to across our plan members. So hopefully I'll have some information to provide to you prior. You guys can look it over. And we'll go into more detail for any questions and concerns you guys might have. And it's kind of a work in progress with each plan. We will present the 3 options that we have available to you. And then from there, you guys can decide. For this meeting, I just wanted to see how you guys run things and how things are going and, get to know the plan a little bit better. And one final thing, just shortly, I know we will be seeing some of you at the SPPTA, so I look forward to meeting you there in person. And we do have a booth set up, so if you guys can stop by and see us, we do have a special dessert function that we want to invite you to. So hopefully you guys can make it to that as well. But that's about all I have for today.
Okay, thank you. Any
Thank
questions?
you.
Thank you.
Thank you.
Is anybody going to the conference?
I haven't
Nobody.
heard. I haven't.
Okay.
I'm not.
Okay, item 6B, Frank Wan with Burgess Chambers and Associates.
Hey, well, good morning. It's great to see everybody. Given that we're in turbulent market conditions, I brought two reports. So if we can start with the handout that has a front cover that looks like this. I want to spend a little bit of time on the market just to put some ease, perhaps, in your own minds as you think about investments. On page 2, the annual returns for stock market has historically gone up and down. But note that 32 out of the last 42 years, on a calendar year basis, the market does go up. So that the takeaway there is, we have really had an extended bull market. So having a bit of a pullback is only natural, but we somewhat forgot about the pullbacks the market has. So really, over the last decade, the stock's been running perhaps a little bit faster than we had anticipated. But on page 3, also to note that we've had global and military and geopolitical events in the past. And as we think about Ukraine versus Russia, that being it's definitely an important event. But looking at whether it was last year's situation in Afghanistan or, the North Korea missile crisis, or even as far back as Pearl Harbor, the average drawdown of these significant events is highlighted in the fourth column, being down 4.6%. So the reminder here is that each individual event should have insignificant impact towards the stock market. But even when it does have an impact, historically, the days to recovery from when you reached an all-time low in your personal accounts is 43 days. So from 43 is down, from the time that we identified a bottom is when you can perhaps hope that the market will recover maybe in a rapid fashion. Pages 4, 5, and 4 and 5 really speaks to the fact that the international stocks has really struggled versus the U.S. stocks. On page 4, you can see that for the past 14 years, owning U.S. stocks has been more favorable. It's been more favorable by quite a wide margin. But on page 5, what you'll find on the right-hand side is that international securities are becoming more attractive. And this is a measure of dividend yields, how you compare a foreign company versus a U.S. company. And in this case, foreign entities in similar asset categories are giving you roughly a 1.7% higher dividend than they have compared to the historical past. And that dividend difference is now in the third standard deviations, meaning that the stocks are becoming so cheap that they are really outside of the normal ranges. But perhaps they're cheap for a reason. And the reason being is that perhaps Europe or Asia might be already in a recession while U.S. is doing significantly better. I do think that our management of COVID and coming out of it especially, that we have been relatively free compared to our counterparts around the world. And even, as of last month, China, Shanghai was still under lockdown. That's 350 million people being in a somewhat of a lockdown for now more than 2 to 3 years, and aggressively in the last 2 to 3 months, right? So China, Shanghai was in an aggressive lockdown for the last 2.5 months, and they finally reopened their doors as of the last week. So that has put a large burden on their economy, and that's why you saw the U.S. dollar continues to rise against other currencies, is because we are doing relatively better. But even as the stock market does, relatively better or worse, there is a point where the stock market and the economy really kind of depart from each other. Meaning that if some stocks get so cheap, and let's pick on Coca-Cola, for example, or maybe even Procter & Gamble, right? So when those companies, blue chip, is going to be around for the next 50 years, is not going to go bankrupt overnight, that there is a point when Wall Street comes back in, even when perhaps the economy doesn't feel as great. just as we went through in 2008, right? The market started to move backwards when we still felt that the market was still in a recession through really early part of 2011. But the market tends to move ahead of positive news that may be in the foreseeable future. So that's some things that we're looking at. I think we've talked about international before, but right now we're paying really close attention to all the key metrics, not only here in the U.S., but abroad as well. And then on pages 6, 7, and 8 highlights the fact that your plan owns a lot of passive investments, and that was implemented roughly 4.5 years ago. And to say that passive investments have really done well, and you have benefited from the rise in just a moderate grouping of investments. Historically, before Vanguard, you really had active managers that went out and tried to pick stocks with the expectation that Ceradex was going to do better than the Russell 1000 growth or Russell 1000 value, and Wells Fargo being better than Russell 1000 growth index. And then 4.5 years ago, that's when you really went into the direction of having a little bit of both in each bucket. So you would have Ceradex and you would have the Russell index, and you would have Wells Fargo and you would have the index. And then further, you would have the Wells Fargo extended or small to mid-sized company index to participate in the broader market. So again, I think that trend has been reflected across the different institutions across the country, and it's been favorable. So on page 7, it highlights that S&P 500 as an index, or 1,500 in this case as an index, has outperformed nearly 80% of all actively managed mutual funds in 2021, which is measured in the yellow. So that means that when you think about passive versus active investments, passive has continued to do well in tough environments, just as we saw in 2021 at the start of this bear market. But on page 8, the issue that we saw towards the latter part of 2021 was the concentration of large companies in the U.S. So if you look at the bottom right of this slide on page 8, you can see that in the large cap growth category, Apple represented 13.36% of the total benchmark. So your manager, Wells Fargo at that point, had to make a decision. Do we want to own Apple at 13 or 14%, or do we want to own Apple at 5, 6, or 7%? So your manager in this case really decided to diversify further and not owning one position in such significant size of 13 or 12%, including Microsoft. So then we hoped that as this sell-off really roared into 2022, that your managers would actually do well. But unfortunately, all of your managers performed extremely poorly in this environment. So that's what really was disappointing, is that we hope that we're paying a premium for managers to protect us when the market goes sour. And unfortunately, in this case, as you probably saw ahead of your report, that for the quarter, your plan lost more than 5%, which is more than we had anticipated. So then I'm going to skip my talk on inflation for now, but let's jump ahead to the managers. So on page 12, I ran a snapshot of Virtus Ceradex, your large value manager, and you can see that there are many blue dots. Each blue dot represents a 5-year block of returns. And what you'll want to identify is hopefully the blue dots surfacing right at the diagonal line or above it, which means that they're performing at or above their benchmark, Russell 1000 value. And historically, you can see that the managers never fared too far apart from the diagonal line, which is really what we want. And ultimately, we want them to spend more time above that diagonal line than being in the south of it. So then look on page 14 for a minute. So further, we decided to take a look at historical stress tests within the value portfolio. So Ceradex manages a group of stocks that's historically blue chip by nature, big companies, averaging roughly $60 billion in size. So you would think that these big companies, being around for as long as they have, would survive, right, the sell-off better than rest. So then you look at their past experiences, whether it's 2002, the sell-off post 9/11, or 2008, the great financial crisis, or 2010, with the European crisis, or 2016 through 18, a period of taper tantrum. All those periods, you can see that Ceradex didn't lose significantly to the index as they did during this past quarter. During the past quarter, Ceradex lost 6.33% when their benchmark was down roughly 1%. So then let's look at some of the other managers in your portfolio. So then flipping ahead to page 18. And notably, very similar charts here, where in similar time periods starting back in 2002 and moving to the latest quarter, Wells Fargo, or Allsprings as they call themselves today, has really never lost by a similar margin as compared to the benchmark of Russell 1000 growth. But this quarter, they lost 12.7% when their benchmark was down 9. Again, the largest spread between their portfolio and the benchmark. And this really starts to, we then start to ask a problem, whether or not managers have just struggled and high qualities didn't matter. So then we decided to take a further look into international portfolio, and that's highlighted on page 22. So on page 22, exact same time frames of stress test as we have seen in the U.S. side, but now flip it over to the foreign side. So in the foreign category, American Funds is a manager that, again, has never lost and has typically bettered the index when the market started to fall apart. But this particular quarter, American Funds lost by 12% when the benchmark was down 5. So then now we looked at 3 different asset classes, and we experienced something very similar across the different asset pools, is that stock pickers just didn't have its day, and especially in the last 3 months ending on March 31st. The world sold off indiscriminately, and any companies that had a projected growth rate of more than 22% or higher, they were sold off more than others, meaning that Wall Street then stopped believing those growth numbers. So they said, if you are growing at 22%, I'm going to say you're not, and I expect you to grow lower. So there's an incredible amount of disbelief in what the companies purported them to be at, including Amazon. And what we saw in the latest quarter was that Amazon as a company actually did fall apart, right? So as we know, in the last 2 years, including the pandemic, Amazon was a winner. They grew in this pandemic by more than 25% per year, but in the latest quarter, they had a loss for the very first time on their earnings since in 2013. So that was really the disappointing news, and therefore the market continues to sell off because people just didn't expect Apple, Amazon, Microsoft to grow at the pace as perhaps they have done in the past. So now I want to pause here to say that I do believe that there are companies that deserve to be sold off. Zillow as an example, right? And everyone was at home looking at Zillow prices, and Zillow for a while was buying your home from you. They offered to buy it from you, but they bought it at a premium compared to their peers, Open Door, or a couple other firms out there. So then, as the market is taking a pause, again, guess what? Zillow is in trouble because they overpaid for the homes that they wanted to get off your hands. A bike that Bonnie rides is called a Peloton, right? So during the pandemic, that people bought these $2,000 bikes and they sat it at home and they paid $25 on a subscription basis to be able to exercise. But once gym reopened, for $20 a month, guess what? You want to actually see other people as well. So you're going to cancel that and put it on Craigslist. So now you can find the same bike for roughly $1,000 on Craigslist or eBay versus buying a brand new a few years ago at $2,500. So these are examples where we think that pre and post-COVID pandemic should have been reflected. And Zoom, right? The teleconference portal we all use, again, very similar example that it went up a lot. Now it deserves to be pulled back a little bit. But companies like Microsoft, right? We don't expect them to go away. And I actually think Microsoft is going to do well because we all use Microsoft still. And they are effectively a monopoly. And last year, they raised their prices by 11.5%. So in this environment, it's not like we're going to shake off Microsoft, yet the stock is down a significant portion, down, nearly 35% since the start of the year. So there are good and the bad, but this particular quarter, everything just got lumped together and was sold off indiscriminately. That's the word I keep going back to. So what I hope for, right, because now we saw 3 examples in different pools of investments, they all perform worse. But in the long run, so look on 23 for a minute, you can see that long run American funds over the last, whether it's 5, 10, or 15 years, has ranked number 10, 4, and first percentile in their peer group. So we can't say that they really suck because they're 99 now, right? But we hope that they can become 1 relatively quick because we have really rarely see them spend much time ranking in the 99th percentile. But instead, if we just look at them again over 5-year rolling periods, unless in this case, let's go back to page 20, and you can see that historically, whether it's these past recessions or not, American funds, as a good example here, has really been the provided example that most of these 5-year blue dots have surfaced above the diagonal line. So what we want to do is really give these managers some time to be nimble and to protect now on the upside. Because perhaps they were oversold on the downside, that we need to give them a chance for the market to stabilize and equalize so that we can reap some of the rewards of the up. So there's the simple saying of buy low, sell high, and I would hate for us to sell low and buy high by switching to another manager in these turbulent environments. That said, kind of coming back in the same blue dots, on page 16, you can see that this really gave us a bit of transparency as we think more about our managers, that Allsprings has really just struggled, right? So now those blue dots, there are probably more below the line than there are above the line. So now it's on our radar a little bit more aggressively to say, well, we could give American funds a little longer runway because of their past track record. But now, with the fact that Wells Fargo has underperformed for some time and they continue to do so, we're going to give them a lesser leash. So between Wells Fargo and Ceradex, we're truly going to watch them very closely. And if they don't recover within the next 6 to 9 months, assuming that the market somewhat finds a relatively stable ground, then we will come back to you with a recommendation for replacement. So in this environment, again, what I'm hoping for is at least 1, your patience, just to let us monitor these managers and with hopes that they're going to bounce back aggressively and recover some of your losses. And then 2, we're going to watch them more closely in their nimbleness to switch out of positions that are bad in their books. I will say that American funds is someone we've been on the phone with consistently, just given the volatility of Russia and Ukraine. And they have already pivoted back in China. With China reopening their doors, their stocks were selling at historically cheap levels, and they're able to jump on those opportunities. We haven't had extensive conversations with Wells Fargo or Ceradex, but we plan to have those tough conversations. And when we do, and if we find anything that's wrong, believe me, we'll be the first to recommend replacements. Any questions there?
Well, this is March 31st. How have they been doing the past 2.5 months?
Yeah, so things are still rocky, and the market is still being very rational in the way it's selling off. We have seen other companies finally started to making changes in the portfolios, just as the latter part of May. So it's the first we have seen really somewhat of a pivotal change for certain managers, and those are the tough questions I'm going to ask as we close out 6:30, coming back to Ceradex and Wells Fargo.
Any questions? Bridget?
I don't have any.
All right, so now I'm going to switch gears to our big report, and I'll start on page 4. So as you can imagine, inflation is on everyone's minds these days, and I apologize if you drive a truck. And I know that people around here probably love their F-250s along with their boats. So the old saying is that prices, high prices, the only thing that'll cure inflation. And for the last 2 weeks, boats are coming down. So that's maybe the good news. So if you're in the market for a boat, just wait a little longer, and I believe you'll see more inventory because 3 miles a gallon is no longer affordable, right? So then looking at inflation compared to this chart on page 4, the uncertainty itself, whether or not inflation is going to be prolonged for an extended period or is going to be short-lived, is what's causing this duress in the bond market. So the past cycles, ranging from 1994 up until really 2016, we have seen bonds being able to weather the cycles of rate hikes. So when the Fed hikes rates, typically they do it by a quarter of a point, and they do it slowly and comfortably, where Wall Street has the ability to adapt and say, hey, you know what, we're going to move on. But now the Fed is saying, well, we're going to raise rates by 0.5% and possibly 1%. So as of last month, the Fed was expected to raise the rates 0.5 this month, 0.5 next month, and then 0.25 for the remainder of the year when they meet. So by the end of this year, we were supposed to be right around the 2% mark. As of last week, their stance changed to say that we could raise the rate 1% this month just to ease inflation, which was reported this past Friday at 8.6% on a year-over-year basis. So 8.6 is a very alarming number, but we also have to keep in mind that the reason inflation is prolonged is because of the Chinese bottleneck. 1 in every 5 freight ships around the world is hanging off the coast, not being able to dump their goods or import their goods on those containers. If you're stuck outside of a port just hanging around the middle of the ocean, your products aren't being moved, and that creates a backlog, and therefore inflation is stubbornly persistent. But what happens when that comes back, right? So there's a lot of questions around whether inflation needs to be controlled or whether inflation can be self-correcting. So the Fed is really contemplating that question. And on top of that, we know that Russia and Ukraine and some of their nearby countries produce roughly 20% of the world's calories in terms of wheat and grains. So then what can we do to offset some of those food and agricultural products around the world to make sure the food prices remain leveled in a way that we can all afford? And then finally, energy, right? Oil prices, we all seen, has risen more than 38% year over year from $4 a gallon to over $5 as this past weekend in certain parts of the country. So these are really the uncertainties that investors face, and that's the tough decision that the Fed has dealt with today. So if you look at the short sell-off here, again, this really tells the story that this particular rate hike has been unique because no one knows where the terminal rate will be because the Fed has changed their stance so many times. Instead of ending their rate hikes at 1.5%, they could end the rate hikes at 3%, right? So that target where they're going to end that rate has moved quite a bit just in the last 12 months. So because of that fear, no one knows how quickly or how fast the Fed is going to raise rates. This is truly a difficult quarter where your stocks were down and your bonds were down, right? We all learned that if you invest in bonds, that's going to help on a rainy day, and if the stocks are down, the bonds should be up. But this is a quarter where stocks were down close to 10%, and bonds were down anywhere between 5 to 8%. So where did you hide your money, right? So that's really the tough area. So then jumping ahead to page 8, and as I mentioned before, we should have only lost 3.9%, under 5%. But your portfolio suffered a loss of 6.5%, and that's where my disappointment comes in with your managers. So we really, again, hope that your managers who are being paid money to pick good stocks will shine in a way that maybe perhaps they didn't in the past first 4 months of the year. Allsprings, as Brenda, you asked, Allspring has continued to struggle, but there is signs of stability. There is, for example, historical prices that we track these things, and even a company like Target, it's selling roughly about 25% below its 20-year averages. The stock market in general sells at a P multiple of 15.5 times the earnings of a typical company, and that's the S&P 500 index. Target, when they missed their earnings, their stock cratered by more than 26% overnight, and now Target as a company, their stock is selling at 11.5 times PE ratio. So again, these opportunities are finding ways towards kind of historical lows, and then that's when Wall Street investors come in because they recognize the long-term investments of whether Amazon or Walmart or Target or even Dollar Store, right, Dollar General, that it's becoming so cheap that they just have to buy it. So that's what we're looking for. It hasn't necessarily happened yet, right, that clear buy signal for everybody, but we're starting to see signs of hope that Wall Street is eventually going to be net buyers versus net sellers, which is driving down the market. And then fast forward again to page 12. So looking across the quarter column and really scanning across, there are truly a lot of negative numbers. But the bright light came from real estate. And as we all know, real estate has just been a rocket in the state of Florida. And if you lived near the beach, in this case, anywhere within 30 miles of the beach, your properties have doubled in the last 2.5 years, right? And that's just crazy to me. But finally, I think we are finding a little bit of stability when it comes to real estate and home prices. But again, we took advantage of it from a pension standpoint by owning commercial properties. Because the same building 2 years ago now cost, minimally speaking, 25% more to build. The replacement cost itself has gone up so much that our properties that we own has benefited, right, from this rise in commodity prices. But at the same time, American Realty has a portfolio of tenants, so 94% of all their properties, and they have roughly 74 properties within their portfolio, is occupied, right? So we're diversified across the country through different tenant pools, and is 94% leased, which means we have a better stable base, right, than say owning a basket of individual homes. So under this premises, our portfolio benefited by more than 8.5% during this past quarter, and for the past year, really it's been the clear winner, earning 29.7%. And then towards the end of last year, remember, we rebalanced $200,000 more into this pool. So the timing of our rebalance being more and overweight into real estate has been favorable. So again, just to understand that we have done a little bit of change here and there, and we added to real estate at the latter part of the year, but that's still having 10% of your assets in real estate was not able to offset, right, the losses from stocks and bonds otherwise. In hindsight, I wish we had more, but right now is probably not a great time to double down on real estate because just in our neighborhood alone, the number of days that homes on the market stretched from 9 to roughly 18 days just in the last month. And finally, in the outskirts of Orlando, we are seeing prices actually being adjusted downward, right? People used to overpay for homes as they come on the market. But now, for the first time, my Zillow alert tells me that this particular area, the average listing price may be reduced by more than $10,000 or $12,000 and $20,000. And what's even crazier is over the weekend, Wall Street Journal did an article in Austin, Texas, right? Austin is now the new Silicon Valley. A lot of money is pouring in, including all the new technology and the young, venture capitalists. So for a while, $15 million homes were flying off the shelves. Who would have believed that? Austin, Texas. They could not build it fast enough, and they just can't build enough $15 million homes. Now they can't move anything that's above $5 million. So again, the market is not limiting itself to really the wealthy buyers. Really, it's been ubiquitous across the board, but activities are softening. So again, the cure to inflation becomes naturally high prices, and therefore we have already seen consumers pull back their spendings. So coming back to the example of Target versus Walmart, Target CEO has actually said, we see people buying less merchandise and goods. Instead, we're seeing their dollars go towards experiences. So on one hand, Target stock is down, Marriott stock is up, right? But at the same time, people can't travel anymore because just in 2 months window, United Airlines just published to say our airfare has gone up 38%. So how do you afford to go on vacations anymore? So now you have to drive. And then with gas prices at $6 per fuel, people aren't going to drive. So all this could become a self-right correction problem if people stop spending. And we are already seeing early signs of people being more conservative. And lastly, the indicator of this is that credit card debt. Prior to 2019, average household had roughly $7,500 in household credit card debt. Now it's surfaced above $7,500 for the first time. During the pandemic, people had nowhere to spend their money. They paid down their credit card. Good for them. But now, somehow, they felt like they were rich, and they just kept spending. So now it's back. So with household wealth falling, with credit card debt rising, there is a point when people was going to wake up to say, I need to get a job, right? So right now, there's still 11.7 million open jobs. So my question is, where have people been? What are they doing, right? So I hope the reality sinks in, right? But all that is going to help us to find certainty. What Wall Street hates is uncertainty, but once we find that certainty, then we can move forward. Otherwise, we can't build in or forecast into the expectations how much Target is going to earn next, or how much Dollar General is going to sell, or whether or not inventory is going to be available for them. So once we find certainty, that's when the stock market recognizes the bottom and finds its way upward. Right now, we're just looking for a level of certainty, and luckily, we're beginning to see it. Right, just as I mentioned before with China, they're opening up, and I don't think they can afford to be aggressive as they have over the last 3 years. Other countries like Taiwan and Hong Kong have already changed their stance. Japan just reopened their borders for international tourists. So all that is going to create a lot of influence for China to reevaluate their policies. And then two, with Russia and Ukraine, obviously that's ongoing. But again, as the world shifts, right, the oil demand, China has already bought all the inventory from Russia. So clearly China is actually going to win from this energy story because Russia was sanctioned to sell their oil anywhere else. So if China is going to buy it for pennies on a dollar, then of course they're going to buy it. So China and India are benefiting from this global oil crisis, but we are also begging OPEC to produce more. And we're also asking our drillers to possibly get more out of the grounds as well. So there's a delay, but the delay is eventually going to cure itself as well. So then lastly, with food, right? We've, I think, consumed probably more than we need. So now we just need to, cater back a little bit. But I think with higher prices in wheat and grain, I tell you, personally, I'm buying less whiskey just because I can't afford it anymore, right? So other people, I'm sure, are as well. And therefore, there's going to be a natural balance. But the Fed, it's end of the day, the Fed's objective is to really slow our economy because truly we've been overheating, right? When you think about just real estate in this sector, it's overheated for some time. So instead of moving at 140 miles an hour down I-4, let's just go back down to 60 to 70. If the Fed can successfully do that, then we're going to be okay. Now, if the Fed puts us in a spiral, we end up going backwards, we're slowed down to a halt, then that's the separate issue. But again, Wall Street is evaluating on a weekly basis whether or not the Fed's going to be successful. And the reason I say Wall Street is evaluating, because on a weekly basis, we look at the 10-year, the 5-year, and the 2-year Treasury yields. Whenever the 10-year yield is lower than the 5 or the 2, that's called an inverted yield curve, and that historically, more than 75% of the time, preceded a recession. We are literally between an inverted yield curve to a normal yield curve, and between an inverted yield curve, normal yield curve on a weekly basis, and this week is inverted, meaning that there is a recession likely. But last week, it was normal. So it's just one of those things that Wall Street has to figure out and digest all the information around the world to really come up with their forecast to say, do we believe in the U.S. economy stabilizing, or do we believe that we're actually truly going to enter a recession? But our firm's view is we don't see a recession for a little while, but early 2023 is very likely that we'll see a potentially mild recession, not a severe one, but a mild one. So having all those said, again, lastly, I'll just say that the stock market and the economy do not or should not move in the same direction. We hope that, again, as we recognize this level of certainty in things that we can't control, then the stock market will be the first to recover because we've already, pulled back more than 20%, right? The worst your portfolio has done throughout, 2008. Let's go back to that slide. Let's look at page 19. The worst year on record, is minus 15%. And right now, I would say your portfolio is down probably not -8 for the fiscal year, -9 for the fiscal year. So it's just something that we shouldn't expect a plan as conservative as yours to be at a situation where that mirrored 2008. 2008 was truly a crisis, a financial crisis. And right now, there's just not as severe or noticeably a crisis as we remember 2008 to be. So I know it's not a pretty report, but I hope at least there's some level of confidence that eventually things come back. And if we just keep in sight the long-term nature of this plan, even though this plan is shorter than others, that we're going to get over this and we're going to get over it better than our peers.
Questions, comments? I will say that historical geopolitical slide you put out, that was very interesting.
Right. Yeah, I thought I was surprised when I first saw that, but it provides a sense of comfort, right? Again, 43 days is quick, and we've seen that. I think the latest is 2020. Who would have thought in a pandemic year the market would be positive? So I think that itself really speaks to the fact that stocks, economy, they shouldn't jive, and when they don't jive, when money starts to be net positive, that's when things change.
Has there been historically times when the stocks and the bonds have both?
It wasn't until 40 years ago with the 1979 to 81 rise in oil prices and the interest rates. So it's been a long time. So 8.6 inflation is highest in 40 years. Yeah, so it's weird times, but what's different, I'll just leave it at this, is that in the late 70s, early 80s, the dollar was actually weak. Today, the dollar just marked its all-time high against the Japanese yen, which really means that our economy is strong relative to everyone else. And our dollar expensive means we buy other goods cheap. So that helps inflation, not hurt it. If it goes the other way around, where our dollar is cheap and the Chinese yuan is expensive, we have further inflation to worry about. But the fact that we're doing so well, and Yellen is talking about removing some tariffs, right, that'll further help the cost of goods, then that, again, there's different ways to control inflation, but I think the Fed is keeping their eye pretty close.
Just to get them off the cargo ships. Yeah,
I think at the minimum, we just need the global supply chain to just move around, right? And I know my wife ordered a dress for a wedding not too long ago, and the supplier canceled 3 times, and she finally got it. Now the wedding's over. She needs to return it. So, little things like that. Maybe we need it, maybe we don't, but things will eventually level.
Frank, what's happening with the cash at the custodians? I mean, it seems like with the interest rates going up, they should be able to get something other than nothing. And I was just looking across. I mean, basically the funds were getting nothing.
Yeah, so remember, the rates hasn't really reflected. The Fed didn't hike their rates until March 6th of this year. So for the period ending March, it's going to be 0. And what happens is, so in Salem, the cash is managed by Goldman Sachs. And typically, Goldman Sachs, in our portfolios, we pick the Treasury Fund, which is the most conservative fund. The Treasury Fund, they charge roughly 0.45% to manage your cash. So until your money market has a yield that's above 0.45, they're going to say, we're not going to charge you anything, but when the times are good, we're going to start charging a fee again. So they're going to collect their 0.45 before they give you any assets. So we haven't risen above that 0.45 significantly yet. Right now, your pool on a one-day yield is 0.45, believe it or not. So you're just a wash. So your net yield for this quarter is expected to be 0.01 or 0.02. But for the quarter ending September 30th, if we were to follow the Fed's path, your cash should be earning about 0.9 to 1.1%. So then your net yield on the cash will then be about 0.6% ish in that kind of, you'll see a higher rate of return on your cash.
Right, because that's the opposite of the pain that we have to go through in our bonds.
Correct.
That ultimately we're going to get something.
Yeah, we do maintain, just by standard, roughly $300,000 in this portfolio, just because our pool distributes so much. Over the last 5 years, you've actually distributed $3.88 million in pension assets. So this is definitely aging pool. So we're mindful of it. But the fact that we do have a little bit more cash, that has actually cushioned the portfolio because, again, you didn't lose money on bonds, right? You didn't lose money on stocks. So the cash position actually helped, even though it was zero.
Anybody else? Bridget?
I don't have anything.
Making sure you're still there.
Of course.
Thank you as always.
Thank you.
Thank you very, very, very much.
All right. Next up, we have our attorney, Bonnie Jensen.
So we sent you a number of memos that are in your packet. So the first thing is reminding you that your financial disclosure forms are due to the Supervisor of Elections by July 1st. We do ask that you file it in a way that you can prove that you filed. I feel like across the state, most of the Supervisor of Elections are accepting them via email. So, and then you get a response back from them, which is, gratifying. I'm also hearing, and I have not yet confirmed this, I really need to sit down and figure it out, but I heard that the Commission on Ethics is actually beta testing the online filing system so that soon you'll be able to, within the next couple of years, to fill it out online and submit it that way. So, hopefully that's coming back, but they're trying it out with the elected officials. So I'm going to try and do that today, figure it out. The next couple of things are just, for your education. So one of them is the IRS mileage rate has gone to 58.5 cents. That is one of the things we're paying attention to because the last time the gas prices went up this precipitously, they did do a mid-year increase in that mileage reimbursement rate. I haven't seen it. I looked the other day, but my thought is it's going to come after July 1st or for July 1st. We sent you a memo about what's happening at the federal level. So if you remember, we talked about the required minimum distribution age increasing to age 72 back in 2019. So first, there is a Secure Act 2.0 that's out there, which looks to increase the required minimum distribution age to 75 by 2029. It's not yet been considered in the Senate, so I'll let you know because there's more things that are in there. So if it actually passes, we can talk about it. But just so you have top of head that they are looking at some pension items. The other thing that happened is that the IRS looked at that required minimum distribution, and so there are two groups that they look at. The retiree, obviously, but aside from them, beneficiaries who can take the money as a result of a retiree passing. So if there are any lump sum amounts of money, and this would apply to any, like your 457 plan or your other investments, an IRA, there are two groups. There's right now the surviving spouse and the non-spouse beneficiaries. What they did was they looked at the non-spouse beneficiaries and decided that there was a group of people who really needed to be in the same position as the spouse. So the spouse is always in in a favored tax position because they can wait to take any of that amount of money until the required minimum distribution age. And then they only have to take what's required to be taken from the required minimum distribution age. So it's a portion depending upon the lifetime expectancy. So they looked at the group and they said, you know, children and parents who are dependent upon the retiree for income because they're unable to be gainfully employed for mental or physical reasons, they should have the same favorable tax treatment as the spouse. And so they changed the names to eligible and non-eligible and moved those group of people into the category. The people who are now what's called non-eligible, they have to take their money out within 10 years and they have to put it into the market. So I shouldn't say put it into the market. They have to spend it. They have to pay taxes on it. They cannot tax shelter it. Whereas the favorable group, the eligible beneficiaries, can keep that money invested, again, can take those distributions in accordance with the calculation on the actuarial tables and don't have to pay the taxes on the full amount. So I felt like that was a real good benefit for people who need that to have happened, who have, you know, parents or children who need that to live. The other thing that's in that memo is a discussion about cryptocurrency. The Department of Labor has come out with a notice indicating that they don't feel that cryptocurrency is a prudent investment inside of a pension plan. So they don't think it's prudent inside of a defined benefit plan like yours. They don't think it's a prudent investment inside of a defined contribution plan, and they don't feel it's even prudent where there's a brokerage window at the end of that defined contribution plan. You know, Frank's not going to bring you that as an investment, so I'm not going to go into great details about it. I do want you to know, though, that the Department of Labor is not authoritative over governmental pension plans. So it's really something we look to for trends to see what's happening in the private sector and knowing that it might kind of filter out to the governmental plans. But I am interested to see what the private sector plans are going to say about holding those types of investments inside of a pension plan. And if you have any questions, we can talk about it. But the last thing is that we're recommending to have an annual review of the signature authorizations. You all have been stable for a little while anyway. And so, you know, your signatures are probably up to date, although I know that Michelle has some signature authorizations for Salem, as well as a generic one that we can send out to your investment managers to make sure that the signatures are up to date.
Didn't we just do that?
Well, this updated one is going to include your, oh my goodness, the DocuSign signatures.
Oh.
But I need your wet signatures underneath it, and then in order for Salem to accept it. And then it'll go along to Salem with a letter that Brenda's going to sign saying, you know, you all are allowed to use your DocuSign signatures.
Okay.
So anyway, I'm recommending you do it once a year to take a look at it. That's all I have, unless you have any questions.
Questions? All right, thank you. Next up is item 7 with the consent agenda. Any questions on payments or the fund activity report? We don't have Tim here to say, I recommend we pay the bills. So
Yeah.
somebody else may have to make that motion.
In that case, I recommend we pay the bills.
I'll second it.
All in favor?
Aye.
I
Opposed? Motion passes. Next up, we have staff reports.
And I really don't have anything for you all. Just want to remind you all of the FPPTA conference. If you all are, anybody's interested in going, let me know. Real quick, wanted to mention that I looked up online and all of your financial disclosure forms have been submitted for all 5 trustees. So,
Awesome, good job.
all right.
Okay. Any trustee reports, item 9? Bridget?
I don't have anything.
All right. And we will adjourn at 11:51.
Thank you very much.
If you guys will stick around for
Thank you.
Thanks, everybody.
Thank you.
Thank you.
Hope you feel better, Bridget.
I hope.